We have David, who's in Highland Grove, Ontario. He's got a question here for David. Go ahead.
Yeah, great show, gentlemen.
Thanks.
My question's on Aliant. I was wondering if at this time the share price is a good entry point, and do you think the dividend is safe, and do you see any rise in the share price and or the dividend? Or can you recommend another telecommunications company? Thank you very much.
These callers are getting smart. They pack about 5 questions into one.
Well, I'll try and answer it straight up. So we like the telecom group. It fits into our theme, predictable cash flows, and in many cases, dividend growth. I think that the dividend is probably safe in the short run, but I would say that Bell Aliant really is an underperformer in the group. We own Verizon as a big holding in the U.S., and as most people know, TELUS has been about our biggest holding for about 3 years. And specifically, I like TELUS because they're very forthright and said 3 years ago, we'll raise our dividend twice a year for the next 3 years, and they did it. They recently came out and said, well, we've done that. Now we'll tell you again, we'll raise it again every year for the next 3 years, but we'll tell you more, we'll raise it probably 10% a year for the next 3 years. Well, investors love that kind of certainty. And the dividend's well covered, and they've got great cash flow growth. So I would prefer to own a TELUS. It might be a little bit less exciting. Bell Aliant, you're making a bet on IPTV and conversion of that business, but I think that it is a less certain proposition than the TELUS.
All right, thanks for that call. We have Bo now, who's in Brampton, Ontario. Hi, Bo.
I'm interested in Brookfield Properties. It's listed on the TSX.
Right.
Would you buy it at today's price, and is the dividend sustainable? Thank you.
Thanks, Bo.
So, Bo, so would I buy it at this price? We have been reducing our REIT exposure a little bit. We've been moving a lot more money to the U.S. than Canada. The Canadian market's underperforming. Some of the U.S. REITs are a little bit more interesting right now, a little more economically sensitive. So we have focused in things like Ventus, which is healthcare REIT, which has been a tremendous performer. And we've also focused our attention a little bit more on the industrial REITs, because the industrial REITs in a little bit stronger environment have better pricing power to raise rents, and their intensification, their occupancy is rising. So I think Brookfield Office Properties has great properties. They are A1 properties. But I think that I would be more likely to focus in the industrials. You know, you get a 3.3% yield. It's about a 50% payout. It's you know, they're covering it quite easily. It's just, it might not be the most exciting near term within the REIT space. And
this Ventus VTR, you said it's in sort of a healthcare? No, it's
this has been a tremendously successful company. The CEO is very bright. The stock market cap has gone from about 20 million to 20 billion over time.
Seniors housing.
Seniors housing. They're in medical buildings, and you have to remember that healthcare is the biggest industry in the U.S. And so healthcare was out of favor for a long time, and in many ways, healthcare has really come back into favor, and it's not very economically sensitive. So I quite like Ventus. Brookfield, I think, is a great company, and I think they're good assets. But you might make a little bit more money in the short run, either in the healthcare or the industrial REITs.
And there we see Ventus VTR, a nice looking chart. No wonder David's so happy. Here's Jose, who's in Toronto. Hi there.
Hi, thanks for taking my call.
Sure.
My question was in regards to Apple, if you would be buying it at these levels and holding it for, let's say, about 5 years out.
Okay.
Thank you very much.
So, Jose, I actually had this conversation just before I came on, and I had a MacBook Air here, and I've got an iPad sitting in front of me. I've got an iPhone in my pocket. And so the fellow asked me, so you must like Apple. And I had to say, you know, we owned Apple for about 4 years, but we've been out for quite some time. The problem is that sometimes stocks become so over-owned that when technically they start to sell off, they become a source of funds in favor of other types of investments. And realistically, I've never seen more Samsung ads in my life than walking. I was in South America 2 weeks ago. One of my analysts was in Asia last week, came back saying the same thing. Samsung really seems to be attacking Apple. And the newer innovations have been less than exciting, changes in size and color, basically. So I think that in order for them to compete going forward, either they're going to have to really innovate, which will impact their margins, or they're going to have to compete on price and go down market, which will impact their margins. So in the short run, we're in a strong market. And if you're in a strong market, own the things that people care about now. And it may be this company is very successful for a long period of time, but it may just be that the stock is overowned and will take some time to bottom out and start to work its way higher. So I'd avoid the stock for now. We're actually short the stock.
Oh, you are short. Okay, you're short Apple. Would a higher dividend and a bigger buyback be a catalyst or a special dividend?
Absolutely, that's what the investors are hoping for. And that certainly would help the situation. But you still have to deal with near-term product introductions and what is it that they're going to come to market with that can have the kind of profitability that the iPhones had. And I don't see it in the very near term.
And Samsung's Galaxy S4 is coming out on Thursday. They're going to unveil that on Thursday night. Here is another pause, a little break for you, and we'll be back. More questions for David right after this.